homeowners across America wake up every morning without homeowner insurance coverage, gambling their life savings on a single roll of the dice. This isn't just a personal finance problem. It's the collapse of a system that's anchored American homeownership for generations, and it's destroying affordable housing in ways most people never see coming. The numbers tell a story that should terrify anyone who cares about housing in America. Since 2019, home insurance premiums have rocketed up by 44% nationwide. In some states, it's even worse. Florida homeowners now pay an average of $6,366 per year. That's $530 every single month just for property casualty insurance. But here's what makes this crisis so devastating. It's not just hitting luxury beachfront properties. It's systematically dismantling affordable housing across the country, forcing families into state-backed programs like California's FAIR Plan, which has seen exposure skyrocket to $458 billion. Let me paint you a picture of what's really happening. In Los Angeles County, a nonprofit housing provider opened a new permanent supportive housing community serving over 100 households. They paid $94,000 for insurance in their first year. The next year, over $519,000. That's a 450% increase for a property that had filed 0 insurance claims. 0. This isn't about risk management anymore. This is about an industry in full retreat from the wildland-urban interface. The math is brutal and simple. According to the National Leased Housing Association's 2023 survey, 93% of affordable housing providers said they would need to adjust operations to manage increased insurance costs. More than half said they would decrease or delay investments in both existing housing stock and new projects. When you're operating on thin margins to serve the most vulnerable populations, a 450% insurance increase doesn't just strain your budget, it can kill your project entirely. Here's why this matters for every American, whether you live in affordable housing or not. The United States needs to build 2.5 million new homes by 2031 just in California alone. Nationwide, we're facing a housing deficit of 4.7 million units, an all-time high. Every affordable housing project that gets canceled or delayed because of insurance costs pushes us further away from solving the broader housing crisis. And here's the kicker. For every $1,000 increase to the cost of a single-family home, an additional 116,000 households get priced out of the market entirely. The insurance industry's exodus from high-risk states reads like a corporate evacuation plan. State Farm, California's largest home insurance provider, announced in May 2023 that it would no longer accept applications for property insurance. Allstate followed suit. The Hartford stopped writing new policies in February 2024. These aren't small regional companies, these are industry giants with billions in assets, and they're walking away from entire states. Desperate homeowners flood into the surplus lines insurance market or state-backed FAIR plans. But even these alternatives are buckling. But the big names are just the beginning. Companies like Lemonade, Farmers Direct, Amguard, and Falls Lake Insurance have withdrawn from California completely. In Florida, more than 30 home insurance companies have vanished from the market in recent years. American National announced plans to pull back from 9 states simultaneously, citing several years of increased frequency and severity of weather events and inflationary pressures affecting both standard homeowner policies and the National Flood Insurance Program. The dominoes keep falling. When major insurers leave, desperate homeowners flood into state-backed programs called FAIR plans, and these programs are buckling under the pressure. California's FAIR plan has seen its exposure skyrocket from $50 billion in 2018 to $458 billion in September 2024. That's a 916% increase in 6 years. Victoria Roach, president of the California FAIR Plan, put it bluntly, "We don't have a lot of money at this point." When fire season really gets going, we're praying for a mild season. Because if we have another large event, we could be in assessment territory really quickly. The January 2025 Los Angeles wildfires proved her fears justified. The Palisades and Eaton fires became the costliest wildfire disaster in U.S. history, causing over $53 billion in damage. The FAIR plan alone paid out more than $2.7 billion to policyholders and had to levy a $1 billion special assessment on member insurance companies. In Pacific Palisades, where almost every home was destroyed, thousands of insurance policy renewals had been refused in just the year leading up to the fires. What's happening in affordable housing specifically is even more devastating because these providers can't simply pass costs along to residents. Unlike market-rate housing, affordable housing operators are bound by income restrictions and regulatory requirements that limit rent increases. When insurance costs triple overnight, there's no easy fix. The crisis is compounded because traditional catastrophe models used by P&C insurers can't accurately price risk for low-income housing tax credit properties. Enterprise Community Partners analyzed properties financed with the low-income housing tax credit in their California portfolio and found that per-unit insurance expenses increased by 56% from 2020 to 2022. But the more recent increases from 2022 to 2024 have been even more severe, with organizations reporting increases of 50 to 500%. According to Enterprise, insurance has become the largest and fastest-rising operating expense in affordable housing, increasing more than 110% since 2017. Consider this real-world example. An affordable housing provider in San Francisco, serving over 100 families, paid about $58,000 for their policy in 2022. This year, that same property managed by housing advocate Maria Rodriguez costs $171,000, nearly a 300% increase. These aren't abstract numbers on a spreadsheet. These are real families whose housing stability hangs in the balance every time their provider gets an insurance renewal notice. The ripple effects extend far beyond housing. Site selection consultant John Boyd Jr. explains, from a site selection perspective, those high insurance rates make it more difficult for companies to recruit and retain a workforce. You think about the pressure transferees are already under with record home prices, high mortgage rates, soaring childcare and healthcare costs. This homeowner insurance crisis is a major problem. But here's what makes this crisis so maddening. Much of it is self-inflicted through regulatory dysfunction. California's Proposition 103, passed in 1988, requires insurance companies to receive approval from the insurance commissioner if they want to raise rates by more than 7%. The law also prohibits companies from using updated catastrophe models unless they're willing to share proprietary information with the public. Since companies won't do this, they're stuck using outdated CAT modeling systems that don't reflect current climate risks. Even worse is California's intervenor process, which has become a racket that enriches professional delay artists while affordable housing providers suffer in limbo. These so-called consumer advocates have collected $14.3 million in compensation since 2013, with 90% going to one group, Consumer Watchdog, which has no actual consumer members. According to the Department of Insurance, filings involving intervenors take 529 days on average, more than twice as long as those without. During this year and a half of delay, insurers hesitate to write policies, leaving affordable housing developers hanging. The human cost of this bureaucratic mess is staggering. Across California, developers are walking away from affordable housing projects because insurance costs have blown holes in their financial projections. In a state that desperately needs 2.5 million new homes, this regulatory-induced paralysis is unconscionable. Meanwhile, the uninsured crisis keeps growing. Over 6 million homeowners nationwide lack any homeowners insurance at all, putting $1.6 trillion in market value at risk. According to data from the Insurance Information Institute, the demographics of who goes without insurance reveal the racial and economic inequities baked into this crisis. 22% of Native American homeowners, 14% of Hispanic homeowners, and 11% of Black homeowners lack insurance, compared to only 6% of white homeowners. Even those who think they're covered often aren't. Approximately 2 out of 3 homes in America are underinsured, meaning their policies don't reflect actual replacement costs or climate risks. American homeowners are collectively underinsured by as much as $28.7 billion per year, representing more than 17 million homes and potentially $1.2 trillion in lost value. Some states are fighting back with mixed results. California Commissioner Ricardo Lara has announced what he calls the most significant insurance reform since Proposition 103. The plan requires large insurance companies to offer comprehensive coverage in wildfire-prone areas as a condition of doing business in California. Companies must write policies in fire-prone areas equal to at least 85% of their market share statewide, increasing by 5% every 2 years. Florida has taken a different approach, focusing on litigation reform and market stabilization. The state has attracted 17 new insurers in recent years, and Citizens Property Insurance Corporation, the state-backed insurer, has actually reduced rates by 5.6% while shedding over 900,000 policies as private companies return to the market. The state also expanded wind mitigation credits, allowing homeowners to reduce premiums through hurricane-deductible programs and structural improvements. But these reforms take time, and affordable housing can't wait. Every month that passes with triple-digit insurance cost increases means more projects canceled, more families without stable housing, and more communities left without the affordable options they desperately need. The broader economic implications are staggering. Senator Sheldon Whitehouse captured the domino effect perfectly. This isn't complicated. Climate risk makes things uninsurable. No insurance makes things unmortgageable. No mortgages crashes the property markets. Crashed property markets trash the economy. It all begins with climate risk. We're watching this play out in real time in Harris County, Texas, which includes Houston. From 2014 to 2024, insurance costs increased 146%, from $1,200 to $2,950 annually. The taxes and insurance portion of mortgage payments grew from 41.3% to 51.8%. Monthly taxes and insurance costs increased by $667, from $458 to $1,125. When housing costs rise this fast, working families get squeezed out, and affordable housing becomes even more critical. The cruel irony is that just as climate change makes affordable housing more necessary, as extreme weather displaces more families and housing costs soar, the homeowner insurance crisis is making it harder to build and maintain. It's a perfect storm that threatens to unravel decades of progress in housing policy. Looking ahead, the National Association of Insurance Commissioners predicts home insurance rates will continue rising through 2025 and into 2026. New tariffs on building materials will likely increase construction costs even more, putting additional pressure on insurance rates. As one industry analyst put it, few states will be exempt from rate increases associated with climate risk in 2025. The solutions exist, but they require political will and regulatory reform. States need to modernize their insurance regulations to allow for accurate risk pricing while protecting consumers from predatory practices. The federal government could expand disaster mitigation programs and provide backstops for state insurance programs. Affordable housing providers need dedicated insurance pools and federal assistance to weather this transition. But time is running out. Every day we delay reform, more affordable housing projects die on the drawing board, more families face housing instability, and more communities lose their economic foundation. The homeowner insurance crisis isn't just threatening individual homeowners, it's dismantling the infrastructure that makes communities viable. The question isn't whether we can afford to fix this crisis. The question is whether we can afford not to. Because if we let the insurance industry's retreat continue unchecked, we won't just lose affordable housing, we'll lose entire communities to climate change and economic displacement. And once that foundation crumbles, rebuilding becomes exponentially harder and more expensive. This is our moment to act before the crisis becomes irreversible and the American dream of stable, affordable housing becomes nothing more than a memory.